Today I would like to analyze HIMSS, one of the largest telehealth companies in the world and one of the best performing stocks in the last year. We are up around 365%, so we're going to take a look at the financials to find out if it's still a good buy right now. The first thing we can recognize is a market cap of 14.32 billion US dollar. This makes HIMSS the largest telehealth company in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and or a declining business. So in 2020, the revenue was around 0.15 billion US dollar. This was an incredible growth, around 80% from 2019. In 2021, we saw the incredible growth again, around 82%. And in 2022, we saw the even better growth, around 93%. In 2023, we saw the very good growth, around 65%. And then in 2024, we saw around 70% growth. So overall, we can see in the last 5 years, we had an incredible revenue growth. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 4.2 million US dollar in the negative. In 2021, it was even worse with 35 million in the negative. In 2022, around 29 million in the negative. And in 2023, we saw the positive free cash flow around 56 million. And then we saw the incredible growth in 2024, around 272%. So it's also a check here in the free cash flow growth in the last 5 years. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024. So this is around 209.43 million. Then we're going to divide it with the current market cap. So this would be around 14,320 million. So then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 1.46. So this is under 4%, so it would not be a check here. But of course, this is still a very young company, and we expect the free cash flow to grow in the future as well. If we ask ChatGPT for future free cash flow assumptions, we can see here in 2025 around 263 million US dollar, in 2026 around 340 million, and 2027 around 470 million. So let's assume for 2027 we can reach around 470 million. So then we're going to divide it with the current market cap, 14,320. So then we're going to get the free cash flow yield for 2027 with our free cash flow assumptions. So the number we're going to get would be around 3.28%. And I think this is a decent number, especially for a company that is still small and that we expect to continue to grow the free cash flow in the future. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 9.4 million US dollar. We're going to add the short-term debt as well. So the short-term debt around 1.9 million. Then we're going to divide it with the current free cash flow, 209.4. So then we're going to get the debt to free cash flow ratio for 2024. So the number we're going to get would be around 0.05. So this is a great number actually. It doesn't take many days to repay the debt with the current free cash flow. So the check here, we like to see that. We also can take a look at the cash on hand, how much money this company has in the bank. We can see here around 300 million US dollar, and that's a huge amount as well. We like to see that. I think this company has a very good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, you're going to calculate the enterprise valuation. This is the current market cap, 14,320. We're going to add the debt. So the debt is around 11.3 million. We're going to take minus the cash, 300.25. So then we're going to get the enterprise valuation that we're looking for. This is how much the whole company is worth. So the number we're gonna get would be around 14,031.05. This now we're gonna divide with the current free cash flow, 209.4. Then we're gonna get around 67. So this is of course quite high, but we also expect the free cash flow to grow in the future. If we take the number for 2027, we get a different number. So we're gonna take the 470 million. So let me know in the comment section if you think this number is realistic. So then we're gonna get the number around 29.85. And I think this is a decent number actually. It's of course it's not under 25, but it's still a young company and we continue to expect the free cash flow to grow. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that especially if we think the company is undervalued. So we can see here the shares outstanding actually increased over the years, but this is also quite normal for the young company. They still want to grow and invest in the business. So it's not a check here, but this is not a problem at all. Can HIMS stock be a good buy right now? So let's start with a positive. So we saw the amazing revenue growth in the last 5 years, sometime even over 80%. We also saw the amazing free cash flow growth as well. This is something we really like to see. The balance sheet is also looking great. This means a low amount of debt and a good amount of cash on hand. The free cash flow yield around 1.46% is also looking quite decent because it's still a young company and we expect the free cash flow to grow in the future. In 2027, the free cash flow yield could be around 3.28%, so this would look already better. Our enterprise valuation to free cash flow ratio around 67 is quite high. We would like to see it lower, but of course in 2027 the number could be around 29.85, so it would look already better for still a young company. But what I don't really like about this company, it has a lot of hype. So right now the stock price is up a lot from the last 2 months, so we can see around 117%. So I think buying right now could be risky and it makes maybe more sense to open a small position if you really like this company. If you found this video helpful, don't forget to like and comment and subscribe for more content.